Hey traders, welcome to Charts and Coffee. Great to have you all here. Happy Wednesday, everybody. Hope everyone's doing well. We've got Kapow today. This is a Kapow Wednesday and probably will be a fairly significant Kapow at that because we're going to get the quarter point rate hike. But I've been getting a lot of questions as to, what is the conversation being had about this particular meeting, this particular statement, and the subsequent press conference. What we're gearing up for is no longer about March. March is a done deal. Quarter point hike, that's what we're going to be getting. The markets are a discounting machine, right? They're always looking ahead and they're trying to figure out, well, how should we be positioned for what's coming around the corner, which is why when things happen that are so different from what was expected, we see the kind of volatility. When traders and investors are unsure about what's coming around the corner, you can see the confusion. That's just the way that it works and always has. So when I take a look at March, you can see here the column, this column right here, that represents where the target rate will be, what that federal funds rate will be, not how many points, not how many basis points or a quarter point. That's not what this means. It's where will that be, okay? And they always do it in these 25 basis point segments. So that's why it's 0 to 25, 25 to 50, 50 to 75. If you've checked out any of the free videos that I've done as we're coming into today's meeting, you're well aware of how we use this FedWatch tool from the CME. It is the best way to block out the noise. It is the best way to really understand what is the most highly discounted, most probable expectation from the Federal Reserve. They watch this. They know what they know. Somebody there, and they have lots of analysts, somebody there knows exactly where the Fed fund futures are sitting. And all the members know, all right, well, in terms of our statement and our decision on rates, this is what's discounted. Nobody but nobody is going to be shocked with that quarter point hike. And they're even going to look at it this morning and see, gosh, there's a very small, it's infinitesimal, but there's a very small amount of expectation for maybe a half point hike. They know where we're going. We're not going to shock the market. So then you go out to May, and this is where it gets interesting. Do we see another quarter or do we see a half point hike? So if at the end of today, where we will be is at 25 to 50, we get that quarter point hike at 2 p.m. Eastern. We go into the May meeting, right? Now we're going to see all the same type of jockeying around, all the same type of reactions to inflation data, growth data, jobs numbers, etc. And now we, as a community of traders and investors, are wondering, quarter point or half point hike in May? And that's how the game is played. And this is how we measure sort of the scoreboard, if you will. Okay, so that is it. If you go Google CME FedWatch tool, you will get this link. I've been telling everyone about it for months and months. It's what I've been using for years and years to understand, what the heck's going to happen without listening to the chuckleheads on television. All right, so moving on. That is what's coming up. 2 p.m. rate decision and statement, which will be pretty interesting. The Wall Street Journal has a great statement tracker. So if you want to see what the differences are, what the evolution of that statement is, because it's usually quite an incremental edit. You can check out, if you just Google WSJ statement tracker, easy way to do that. And then press conference at 2:30, gang, and there should be some fireworks with that one. But as always, gang, this show is about your questions. That's the hot zone. That is the main hot zone that we are all going to be watching. So let's jump into your questions, kicking it off with, hey there, Michael, XLE P, sure. XLP. What do we have going on in staples? Generally speaking, there are two defensive sectors, staples and utilities. Staples are, well, were, right? Let's take a look. What was the structure of staples up until January 21? It was an uptrend. We've had chop ever since then. How do I measure that? The yellow trend on my JT trade flag, or the yellow lower row of the JT multi-trend. Whichever one you have, you see that yellow, we have a neutral, non-trending market, but a ton of bearish momentum. Red Momo flag, red top row. This means that we've got a lot of downward pressure, but an overall neutral market. So overbought, oversold, slow stochastic, ready, aim, fire. That's the way you want to look at those edges, right? In chop, our edge is at the edge, right? Our advantage is at the edge. So we define edges with the automation of Darvis 2.0. You can grab that right here from countdowntrader.com and use the slow stochastic. I mean, I've taught this for many, many moons. And oh, by the way, Trish put a great update out yesterday for those of you that maybe haven't yet checked out countdowntrader.com, and it's just countdowntrader.com. I know I don't have my little notepad up there for you all, but it's countdowntrader.com. And you can see what we've been doing so far this year. And you know, it doesn't mean that we're going to have smooth sailing all year long. Of course not. I don't show you those things to say, hey, look how good I'm doing. Good for you, Rog, right? I could totally understand that response. Whenever Trish and I put together any kind of content, the what is very much, you know, what are we using? Grab candles, propulsion, Darvis, stochastic, you know, what are we using? And then why are we using it? We always explain that because the whole idea is you want to be able to do this for yourself. I'm here to guide you. I often think about it when my husband and I go fishing, and if we've got a guide for that particular trip, which we don't do very often, but if we do, if we're going somewhere new and we want some local knowledge, you know, the guide might be there to tell us, hey, over there, cast over there. We've had good luck over here. But my husband and I are still putting, you know, if we're casting light tackle, we're still putting the shrimp on our hook. If, you know, whatever it may be. For using artificials, we're still the ones doing all that, tying the knots and whatever. But the guide helps us improve the probability of catching some fish. That's the idea, right? So if you come away from anything saying, gosh, that was really helpful, but the guy did all the work for me, I didn't learn anything from that. That's where the problem starts. So again, that what are we using and why are we using a conversation is really going to be, you know, sewn into everything that I do. If you have questions, this is the great time to ask. So XLP, we're long. It was a difficult journey, though, Michael. Not all of the triggers, for those of you that master, you know exactly what I'm talking about. The different price levels at which I will buy calls in XLP. Not all of them survive that little bit more volatility that we got, you know, below the 200, but the conservative did, and that's what matters. The conservative is our larger position. It's already making up for what we had to take by way of paper cuts in the aggro and the moderate entries. So it's on track. I like where we're sitting right now, Michael, on that XLP. Now, we also, just along the lines, I know you didn't ask, Michael, but along the same lines, we have exposure to Mo. You can see the gorgeous volume ledge right there. We have exposure to Mo as well, which is a relative outperforming stock within the XLP. So thanks for the question. All right, moving on to important questions. Oh my gosh, I love it. What is my oh my gosh, Hamilton, who is going to go by a hyphen, I believe, this year. He's adding his mother's maiden name to his name, which is, you know, it's pretty cool. Or Verstappen. You know, I will tell you, I'm a big Christian Horner fan. So in that, I think he's a great team principal. But yeah, I'm a Verstappen girl. Yeah, go Red Bull. Both are relative outperformers, absolutely. Um, unless race is going to finally show us something. So if we have, yeah, we have two very, very, very good drivers. Yeah, you look at race, you look at Ferrari. Look, Sainz and Leclerc are doing well. There's a good chance we might see them number three on the constructors championship. Yeah, it could be very interesting. All right, moving on. Hey there, Philip. On the Apple one weekly. Okay, cool. Step out. Do that weekly. By the way, Apple has been in the last two issues of the weekly. So we have this weekly outlook that I'll take a look at for the market, and we send it out to all the Simpler members and via an alert. So you know that Apple has been what I've called a linchpin for the past two issues of that weekly report. And from a weekly perspective, it's very tempting to look at this as a potential zone of support. I'm with you. The 55 exponential, I use the 55 propulsion tool from Simpler. That has the point of control overlapping with it. There's a lot to like. Do I think that's going to be basically what salvages the daily chart? We're definitely duking it out at key support levels. But I will say that if there's a path of least resistance at this point on the daily, I'd have to say it's down. And if there's a path of least resistance on the weekly, it's still rather neutral. So you might say, well, Rog, how do I reconcile this? Weekly for me is a longer term position trade or part of my portfolio, right? Something which we're going to address once a quarter in the Sector Secrets Mastery. But that also means I've got a more weekly oriented risk tolerance. You know, how much could a market move over the course of weeks is going to be far larger than how much a market could move over the course of a few days. And of course, the weekly structure can be different than the daily, as in the case of Apple. And my time horizon, right? How long I'm willing to hold the trade is also far longer using that weekly. So I don't have a problem at all, Philip, with looking at Apple on that longer time horizon view and giving it 6 months to sort of make the team. I think a lot of traders think once they've invested in something, that's it. It's a marriage, right? Till death do us part. And that's not how portfolios really should work. It should be more along the lines of spring training in baseball. Who's going to make the team, right? It should be more along the lines of you've got this span of time to earn a spot on the roster, right? So I will give, if I decide to do something with Apple, I'll give it up to 6 months to show me it's doing what I think it should, and that it's earned a spot on my roster. My roster meaning my book of investments. Call them position trades, call them investments, it doesn't matter, but that longer time horizon conversation. So you can look at a long call, but remember, we're talking minimum 6-month time horizon, and just kind of expect a little bit of volatility between now and then, because XLK, QQQs, they're in downtrend. So Apple, even though it's probably the most important stock in terms of XLK's influence on other indices, those tides are going out. So Apple's going to have to motor even harder to overcome that. So I hope that makes sense. And if you're interested in the slower moving macroeconomic analysis, what that tells us about sectors, what those sectors tell us about what we can expect on a longer term time horizon, that's coming up. I forgot the date. In April, we're going to do our very first quarterly look at my investment book, what I'm doing, right? We're going to be doing that really, really soon in the mastery. So super stoked about that. All right. Do I think AMD is a good short? All right. Yes, I would. I do. The structure is there. Red grab candles. We've been flirting with, see how the bounces are a little bit more volatile. So we go red over red, bearish momentum, bearish trend, neutral, short, returns to the bearishness, goes a little neutral, short. So as long as you are calibrated to the behavior of these bounces, should be fine. Should be fine. I do like the path of least resistance. Yeah, for sure. Heading lower. All right. What about the euro? We've been talking about the euro for months, right? Here in Charts and Coffee and also back in the memberships. And we first faded the 115 area, which has been very good to us. But that was then, this is now. And so now what is the plan? The plan is to acknowledge the double red market that we're in right now. And why can't I get rid of this drawing tool? All right. So the plan is to acknowledge the double red market trend that we're in right now and look to short the rip. I've been looking at something even as close as the 111 handle. So we can rip up to 111 on 6E. 6E shorts are valid, long puts and FXE. Yeah, I love that trade. That is my preferred way to play US dollar strength. So if you've been looking at UUP or US dollar index, remember that's nearly 58% euro. Why not just go right into the correlation that is a negative or inverse correlation, which is strong dollar, weak euro? And that's been the plan and will continue to be for some time. All right. So as far as lightening up existing exposure, I think I look at it this way, Stephen. If we know the volatility is coming and we're not in a situation where we're risking a disproportionate amount of our capital by way of position size or cost per trade, both matter. I think that I think high volatility, gosh, what's my glasses today? I think high volatility is something we all need to learn to navigate through, but are we equipped to do it? So to your point, if we have a situation where we've had maybe a little bit larger position than we want, maybe too much aggro positioning by way of the target that we'd like, in that regard, yes, lightening it up would make a lot of sense. Hey there, Jamie, loving sector. Hey, we're going to start our we've had this big I don't know, promotion, relaunch, offer, whatever you want to call it. I'm not a marketer, but I don't know, whatever you call it. But we have probably one of the coolest packages that I've been able to offer you all, which is for those of you that want to come in and say, Rog, before I commit to a quarter or even a year, can I just hang out with you for a month? Can I see what you're doing? Can I see the tools with which you're doing it and just get an idea if this is right for me? And I thought, yeah, it's a great idea, right? Let everyone, before I waste your time or money, I know that in a month, you're going to leave a better trader. If you do head out after a month, no harm, no foul, and I wish you the best. I do know this. My mom always said, leave something better than you found it. And I believe in that, whether it's a show in our 20 minutes together or a month in the mastery. So come check out what we're doing. One thing I can promise, A, you're going to get your hands on some of the best tools that I use. And B, you're going to learn a lot more about the way the markets work without all the gobbledygook that you hear on television. You're going to emerge a better trader. And then, imagine after a quarter or a year. But I do know that that month can be a needle mover. And that's why I was so excited about the fact that for the first time, we're actually offering folks a month. And then we're going to do the quarterly thing. And we're doing some bonus sessions. So I'm very excited about what we have coming up over the course of about the next month. So I appreciate that. Do I set an alarm above or below the wave to take a paper cut? No, Jamie, although you could, right? You could always use your platform as a second set of eyes, always, right? If there is a level that you want to be alerted to, there is no harm in letting your platform, which I teach you all to train to be your trading partner, right? Most of us trade alone. My cat can't put in trades, although he has. But we need a trading partner if we're not going to be glued to this all day. And I actually think it's not beneficial to be glued to the monitors all day. So I let my trading partner, my platform, do a lot of the heavy lifting. So I have no problem with that, but I still will use the percentage that I teach you all, Jamie. Remember, on some of the trades that we took heat on yesterday, remember, those were 1.25% account risk, right? 1.25% account risk from the aggro and the moderate cumulatively 2.5%. So we're very cognizant of when we get in at an aggressive level, what would be the downside in our account, right? So I still like the percentages. However, yes, I think I'll do that sometimes too. I want to be aware of when a green grab candle is going to go blue or red, and we can put that right on the chart. Yeah, I agree. That's no problem with that, but I won't necessarily cut the trade if that makes sense. We'll talk a lot more about that here. And actually, now I'm late. So, gang, as always, thank you so much for joining me for Charts and Coffee. And I saw a question about Target. No, I'm not really interested in Target. Too much chop, maybe at a gap close. Some of the things that we are interested in discretionary have been to the downside, like Nike, right? Taking advantage of the trends. So I hope that helps, Jose. All right, gang. Have a great one. 2 p.m. statement, 2:30 p.m. presser. Heads up. Keep your Dramamine handy. See if on the tail end of those events, we see the kind of volatility that we can take advantage of. Be good to each other. I'll see you tomorrow.